Have you ever wondered how the fluctuating interest rates impact the world of commercial real estate? Well, today we're diving into that very topic, exploring the nuances of the rate environment and its implications for commercial real estate investments. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a recent article by Madison Mills dated May 28, 2025, the discussion focuses on the current rate environment and how it affects commercial real estate. As interest rates continue to fluctuate, the impact on commercial real estate investments is significant. Investors are keenly observing these changes, as they can influence both the availability and cost of capital for real estate projects. The article highlights that in regions such as Kitchener-Waterloo, London, and Cambridge in Ontario, the effects of interest rate changes are particularly noteworthy. Multifamily properties in particular are sensitive to these shifts, as they often rely on financing to remain viable and competitive. With higher interest rates, the cost of borrowing increases, which can affect the overall return on investment for property owners. On the other side of the border in the United States, the commercial real estate market is also closely tied to interest rate movements. In markets like Washington, where there has been a surge in commercial real estate sales, investors are weighing the benefits of locking in current rates versus the potential for future rate hikes. Multifamily and institutional deals have been leading the charge, reflecting a strong demand despite the rate environment. It's clear that both Canadian and American markets are navigating the complexities of interest rate changes, each with its unique set of challenges and opportunities. As we continue to monitor these developments, it's essential for investors to stay informed and adaptable, ensuring they make well-informed decisions in this ever-evolving landscape. In recent news, Washington's commercial property market is experiencing a notable resurgence, driven by a surge in multifamily and institutional deals. The registry reports that this recovery is particularly pronounced, indicating a strong demand in these sectors despite the broader economic challenges. The multifamily sector is at the forefront of this growth, with several turnkey multifamily communities in Tacoma coming onto the market. These properties are drawing significant interest from investors looking to capitalize on the current market dynamics. This trend is mirrored in institutional deals, which are also seeing a boost as investors seek stable, long-term returns. This uptick in activity is not isolated to Washington. In Ontario, areas like Kitchener-Waterloo, London, and Cambridge are also grappling with the effects of interest rate changes on commercial real estate investments. Multifamily properties in these regions are similarly sensitive to rate fluctuations, affecting their financial viability and attractiveness to investors. The cross-border relevance of these developments is clear. Just as Washington's market is navigating the complexities of multifamily and institutional investments, Ontario's commercial real estate sector is also adapting to interest rate impacts. This highlights the interconnected nature of the real estate markets across North America and the importance of staying informed on both sides of the border. In a recent development reported by the Chicago Business Journal, a significant property sale in Chicago's South Loop is signaling renewed confidence in the city's retail sector. The transaction involved a two-tenant, ground-floor retail property, highlighting a positive trend in the market. According to Alex Zorn, a staff reporter at the Chicago Business Journal, this sale is a testament to the growing optimism surrounding Chicago's retail market. The property, which was sold courtesy of Marcus and Millichap, reflects a broader recovery in the retail sector, driven by a combination of strategic location and tenant demand. The South Loop area, known for its vibrant community and proximity to downtown Chicago, is becoming increasingly attractive to investors and retailers alike. This particular sale underscores the confidence that stakeholders have in the potential for retail growth in this region. As the Chicago retail market shows signs of recovery, it's important to consider the implications for other areas, such as Kitchener-Waterloo, London, and Cambridge in Ontario. These regions are also experiencing shifts in their retail landscapes, although the dynamics may differ due to local economic conditions and consumer behavior. In the United States, retail markets in urban centers like Chicago are often seen as bellwethers for broader economic trends. The South Loop property sale could indicate a turning point where investors are beginning to see opportunities for growth amid the challenges posed by the current economic climate. It's crucial for investors in both Canadian and American markets to stay informed about these developments. By understanding the factors driving retail recovery in places like Chicago, stakeholders can better anticipate similar trends in their own regions and make strategic decisions accordingly. The commercial real estate market in South Florida has been navigating a unique set of challenges and opportunities. According to Tom Hudson's article, despite the broader economic hurdles faced by cities like San Francisco, Chicago, and New York, Miami, Fort Lauderdale, and West Palm Beach have managed to maintain a relatively stable market. This stability is largely credited to the influx of companies and workers moving to the region, along with the establishment of new firms. These factors have helped to insulate the South Florida market from the more severe impacts seen in other major urban centers. However, the market is not without its challenges. New presidential policies, including immigration enforcement and trade wars, alongside interest rate uncertainties, are contributing to an environment of caution among investors. CoStar's Director of Market Analysis, Juan Arias, notes that this uncertainty often leads to a freezing of investment dollars as stakeholders await clearer economic signals. In the first quarter of 2025, South Florida saw nearly $3 billion in commercial real estate deals, with a notable increase in sales for office and apartment buildings. This uptick suggests a strong appetite for high-quality, low-risk investments amidst rising economic uncertainty, as observed by the Miami Association of Realtors. Despite a decrease in the volume of industrial and retail property sales, the value of transactions continues to rise, indicating a focus on larger, more valuable properties. The sustainability of South Florida's real estate market is closely tied to its population growth, which has been significantly bolstered by international migration. Between 2020 and 2024, foreign-born residents played a crucial role in offsetting the outmigration of locals, contributing to a net increase in the region's population. However, the recent crackdown on immigration by President Donald Trump and Florida's new laws pose a threat to this crucial source of demographic growth. A slowdown in international migration could impact the apartment and industrial building markets first, as these sectors have been expanding rapidly to accommodate the influx of new residents. With moderating demand, particularly for high-end luxury apartments, the market may face a divergence, especially considering the median renter income is below $60,000. Despite this, moderately priced apartments continue to experience high demand, with Miami ranked as the most competitive rental market in the United States by Rent Cafe. The ongoing health of South Florida's job market, which boasts one of the lowest unemployment rates among large metropolitan areas, is critical for supporting real estate growth. Yet the growth rate of the labor pool has slowed, which could have implications for future employment-driven demand in sectors like office, industrial, and retail real estate. In a recent transaction that underscores the dynamic nature of the commercial real estate market in Arizona, SRS has successfully completed the sale of a 31-acre commercial land parcel in Santan Valley for $10 million. This significant sale took place at the northeast corner of Hunt Highway and Gary Road, marking a pivotal moment in the commercial expansion of the rapidly growing Southeast Phoenix submarket. The property was originally acquired by Winco Foods from Miller Global in 2023. While Winco has retained a portion of the site, specifically 10 acres for a new store, the remaining 31 acres were sold to a joint venture between Scottsdale-based Pennant Development Limited Liability Company and Nashville-based Realm Limited Partnership. This collaboration has appointed SRS to manage the leasing for the upcoming Skyline Ranch Marketplace Retail Center. The Skyline Ranch Marketplace is set to feature over 225,000 square feet of retail space, catering to the burgeoning residential population in Santan Valley and its neighboring communities. SRS is actively working to secure pre-leases for the center's junior anchor lineup, 2 shop buildings, and several pad sites, aiming to attract a diverse range of retailers to the development. Speaking on the development, Ed B., Executive Vice President and Managing Principal with SRS, expressed enthusiasm for the project's progression. He highlighted the foresight of both Winco and Pennant in bringing a high-quality retail development to this underserved trade area, a vision that was initiated over a decade ago by other parties. The completion of this transaction and the forthcoming development of the Skyline Ranch Marketplace are poised to significantly enhance the retail landscape of Santan Valley. As the area continues to grow, these developments will play a crucial role in meeting the needs of its expanding population. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.